There's a very specific kind of pain that investors feel right now. You watched the stock market hit all-time high after all-time high. Nvidia, Apple, Alphabet. The headlines made it look like everyone was getting rich, except you. Maybe you waited for a dip. Maybe you thought it was a bubble. Maybe life just got in the way. And then, just when you thought you'd missed stocks, gold went on a historic run, from $2,000 an ounce to over $5,000. The biggest gold rally in a generation. That feeling? That painful mix of regret and panic that makes you want to throw money at anything just so you don't miss the next one? That's FOMO, and it is quietly destroying the financial decisions of millions of investors right now. But here's what I want you to hear. FOMO doesn't just make you feel bad, it makes you think irrationally. It makes you rush. It makes you skip the questions you should be asking and jump straight to, where do I put my money right now? But that is exactly the wrong question. Today, we are not going to tell you what to buy. We are going to do something more valuable than that. We are going to help you think. Let's start with equities, because that's where the real story gets interesting. So let's talk about equities. If you've been watching the headlines, you'd be forgiven for thinking the entire stock market has gone through the roof. But look a little closer at the numbers, and a very different picture emerges. Just 7 companies, Microsoft, Apple, Nvidia, Alphabet, Amazon, Meta, and Tesla, were responsible for more than half of the entire index's gains over the past 2 years. 7 companies out of 500. Now here's where it gets really important to be precise. If you held a simple S&P 500 index fund, you actually had a phenomenal 3 years, around 26% in 2023, 25% in 2024, and 18% in 2025, 3 consecutive years of double-digit gains. The real FOMO story isn't about index investors at all. It's about the people who sat in cash. And there were a lot of them. In 2023 alone, over $1 trillion flowed into money market funds, people waiting for the perfect moment to invest. Those people missed 3 back-to-back double-digit years. So the question isn't, did you miss the rally? The question is, were you in the market at all? And if you were, you probably did better than you think. But here is where smart investors pause and ask the next question. Those 3 years of strong returns, what have they done to market valuations today? Because past returns don't tell you what comes next. And understanding what valuations are telling us right now is exactly what separates a reactive investor from a thoughtful one. The Shiller CAPE ratio is currently sitting at approximately 40. The only time in recorded history this ratio has been higher was December 1999, right before the dot-com crash, when it peaked at 44. What followed was a 49% collapse in the S&P 500. Before the 2008 financial crisis, the ratio stood at just 27, and that was enough to precede a devastating crash. Today, we are sitting at 40. The long-term average is just 17. This does not mean a crash is coming. Nobody knows that. What it does mean is, the easy returns from simply being in a broad index may be harder to repeat over the next decade than they were over the last 3 years. Now, within that expensive market, the 7 mega-cap AI stocks that drove most of the gains are the most stretched of all. These are the companies whose valuations make even Wall Street nervous. This does not mean a crash is coming. Nobody knows that. What it does mean is, the easy returns from simply being in a broad index may be harder to repeat over the next decade than they were over the last 3 years. That is not a reason to panic. It is a reason to think carefully. But here is where the story gets genuinely interesting. That CAPE ratio of 40, that alarming headline number, is heavily distorted by those 7 mega-cap stocks sitting at the top of the index. Strip them out and look at the rest of the market, and a very different picture emerges. Take the Russell 2000, the index that tracks America's 2,000 smaller companies. It currently trades at a price-to-earnings ratio of around 18. Compare that to the S&P 500 at 22 to 24 times earnings. And on price-to-sales and price-to-book measures, small caps haven't been this cheap relative to large caps since 1999. The last time this gap was this wide, The Russell 2000 went on to outperform the S&P 500 by 99% over the following 7 years. Now, we are not saying history will repeat. It never does exactly, but this is precisely the kind of context that helps you think more clearly rather than just reacting to the headline index number. Now let's talk about gold, because this is where the FOMO really stings. In 2025 alone, gold posted more than 50 new record highs. It delivered a yearly return of over 60%. Over the past 2 years, gold prices have roughly doubled, and in January 2026, it hit an all-time high of $5,595 an ounce. Gold didn't suddenly become valuable in 2024. This rally was driven by a combination of forces that had been building for years: geopolitical uncertainty, record investment demand, and crucially, massive buying from emerging market central banks. Countries like China, India, and Turkey actively moving their reserves away from the US dollar. Those forces haven't gone away. With the Middle East conflict, questions about US dollar dominance, and persistent inflation, the structural case for gold is still very much intact. Gold has pulled back from its January high and is currently trading around $4,600. Here's some useful historical context. The current gold bull market began in 2022 and has generated approximately 200% returns so far. But both previous major bull markets, the 1976 to 1980 cycle and the 2001 to 2011 cycle, produced 500 to 600% cumulative returns before they ended, and both experienced multiple corrections of 10% or more along the way. We are not saying gold will keep going up. Nobody knows that. What we are saying is this: understanding why gold ran is more important than the price itself, because that understanding helps you make a rational decision based on your goals, your timeline, and your attitude to risk. So we've looked at equities, we've looked at gold, and hopefully by now you can see that the story is far more nuanced than the headlines suggest. But here's the question we know you're still asking. Okay, so what do I actually do? Our honest answer: we can't tell you what to do, not because we don't want to, but because nobody can, because the right answer is completely different for every single person watching this video. What we can give you is a framework, 3 questions, that if you answer honestly, will do more for your financial future than any hot tip ever could. Question 1. What is my time horizon? Are you investing for 2 years or 20 years? This single question changes everything. Assets that look terrifyingly expensive over a 2-year horizon can look perfectly reasonable over a 20-year horizon. If you need this money soon, that matters enormously. If you don't, patience is your biggest advantage. Question 2. What is my actual risk tolerance? Not the risk tolerance you think you have when markets are going up. Your real risk tolerance, which only reveals itself when your portfolio drops 20% and you're checking your phone at 2 a.m. Be brutally honest with yourself here. An investment that's right on paper but keeps you awake at night is the wrong investment for you. Question 3. Am I diversified? Or am I just exposed? Diversification doesn't mean owning 10 different things that all go up and down together. It means owning assets that behave differently from each other, so that when one falls, another holds steady. Equities, bonds, commodities, cash, international markets, real diversification spreads risk across genuinely different asset types. So let's bring this all together. Equities have run, but the rally was narrow. 7 stocks drove most of the gains. Gold has had a historic run, driven by real structural forces, but it's volatile and demands patience. And FOMO, that painful feeling that everyone is getting rich except you, is not a strategy. It never has been. It never will be. The investors who build real wealth over time are not the ones who caught every rally. They're the ones who stayed calm when others panicked, who asked the right questions instead of chasing the right tips, who understood that investing is not a race, it's a journey. No one builds wealth from a single investment. Wealth is built from a habit. The quiet, unglamorous discipline of saving consistently, investing regularly, and staying the course when markets test your patience. Markets have always rewarded those who showed up repeatedly. not those who timed it perfectly once. It's not about the one big move. It's about the 1,000 small ones. Your time horizon, your risk tolerance, your diversification, those three things, may applied consistently, will always matter more than whether you bought gold at $2,000 or $4,600. If this video helped you think more clearly about your finances, that's exactly what Simply FinCon is here for. We don't do hot tips, we don't do hype, we just break down complex financial concepts, simply, honestly, and without the jargon. Hit subscribe, drop a comment below telling us what topic you want next, and share this video with someone making financial decisions based on fear right now.